when we have sort of more flat periods like right here. During this period, it's less sell limit orders, so it's easier for a buyer to move the price. But then we also have the sort of walls like right here. That means that we have lots of sell limit orders. But it's hard to show because the market is moving all the time. But I hope this was a good, simple live demonstration of how the order book and depth of market can look like. All right, so now it's time to take a look at buy side and sell side liquidity, or in other words, BSL and SSL. And don't worry if this sounds a little bit complicated, it's actually very simple. So, what is buy side liquidity? Well, buy side liquidity is simply the cluster of buy stop orders that are usually above swing highs. So these are basically stop losses from shorts and breakout entries from longs. Because remember here what a buy stop order is. A buy stop order is when the price goes above a certain level, it triggers buy orders. So as I said, this can either be from people that want to buy when something maybe breaks a key level, like a swing high right here, or it can be short traders because people that are going short, that are betting that the market will go down, they actually set their sort of stop loss to the upside. And when the short stop losses get triggered, it leads to buying pressure. But here, the opposite of buy side liquidity is sell side liquidity, or for short, SSL. And this is basically the cluster of sell stop orders below a swing low. So this is often normal stop losses from longs. It can also be breakout entries from shorts. But the most simple way to think about it is that many traders, let's say we have a low right here, many traders that just bet that the market will go up will often place their stop loss orders below a key low level like right here. So if the price then falls below this level, these stop loss orders get triggered and it leads to more selling pressure. And that is what I tried to demonstrate with this image right here. So imagine this is a market, maybe like something like this before. We have a nice trading range. So here we have, a swing low. Here we have a quick, a swing high. What will often happen with this swing high and swing lows is that just above the swing high, we will have a cluster of buy stop orders. And remember, these orders, if the price goes to this price, it will lead to more buying pressure. And the same thing with the opposite is true with the sell stop orders. Below key low levels, like right here, we will often have many, stop losses. And when a stop loss gets triggered, it leads to selling pressure. So you can think about buy side liquidity as sort of hidden buying pressure if the price goes to that level. And you can think about sell side liquidity as hidden selling pressure if the price goes to that level. But here, and this is very important, smart money, remember, smart money is, big traders like big banks and hedge funds, they will actually often target these levels. So they will on purpose try to drive the price to these levels because if they get triggered, it creates a wave of forced market orders. So if we trigger buy stops, it leads to forced buying pressure, right? And if we trigger sell stops, it leads to forced selling pressure. And this provides the liquidity that the smart money need. So many times what smart money will do, we will talk about that later. Let's say that we have a key level right here. So the smart money knows that we have many buy stop orders above this level. What they can then do is that they can, on purpose, push the price into these buy stop orders, which lead to more buying pressure. And why does the smart money want to see buying pressure? Well, many times what they do is that they do this when they want to sell because they want extra buying force that they can sell into because they have so much to sell. Remember, smart money have so much money, so they need this buying pressure to be able to sell. And this right here is actually a kind of setup I will talk about later on in this course that we as traders can take advantage of to trade and hopefully as a result make more money. And here, a key takeaway from these slides is that stops, whether it's buy stops or sell stops, are relatively predictable. We can't know exactly all the buy stops and sell stops most of the time, but we can look at the chart and try to figure out where is it most likely that we have many buying stops and where is it most likely that we have many sell stops. Right, so now let's jump back here into TradingView. We are still here on a Bitcoin chart and we are on the daily time frame. So every candlestick on this chart represents 1 day. But now let's try to see if we can find some buy side liquidity and sell side liquidity on this chart. And remember here, buy side liquidity is often found above key swing highs and swing lows. So the best example on this chart I can see, this is such a good example, is that if you look right here, we actually had not only one high, two high, but three highs. And this was the all-time high for Bitcoin. So this is a level that so many traders are trading. So many traders are paying attention to these levels. So many times there will be a lot of orders around these levels. So we can pretty safely assume that above this level right here, we had many buy stop orders. So remember, if the price reaches that level, can lead to buying pressure. So maybe right here, in this case, maybe right here when the price came up to this point right here, maybe this led to buying pressure, and maybe that is what smart money took advantage of. Just remember what I talked about. Many times the smart money want to trigger the buy stop orders and then reverse the price to the downside. So it looks like this was maybe what happened right here, and I will actually return to this later on. What we now need to understand is that above the very important level, like right here, we often have many buy stop orders, and also right here, we probably have many buy stop orders, and so on and so on. The opposite of course, also, if you, for example, look right here, it's very possible that we have many sell stop orders below a key low. And maybe that is what led to the wick right there. Who knows, right? But a more clear example of outside liquidity is a general tips for you guys that if you want to find real buy side and sell side liquidity, it's often good to focus on the most significant levels, the levels that are sort of clearly visible on the chart. For example, if we look at this price movement right here, this was the brutal crash. The date was back here in February when Bitcoin dropped like 14% in a day. So much volume as well, right? Brutal day for absolutely brutal day for Bitcoin. But when we have these moments in time that are super clear and that many traders are paying attention to, these are the levels where it's most likely that we have lots and lots of liquidity. So I would not be surprised if we have lots of sell side liquidity below this low right here. If the price eventually goes down to this level, it's very possible that we have so many, stop loss orders getting triggered, and this usually leads to very interesting price action. But what I can also just mention is that one factor to have in mind is that the longer time it goes from the price getting triggered. So if we wait for a very long time before this level gets triggered, it can actually affect, of course, the sell side liquidity below this level. Right, so now it's time to take a look at the liquidity sweep, the liquidity grab, and the liquidity run. And these are actually three specific liquidity patterns you can start trading relatively quickly. But before you can do that, we of course need to learn about the patterns. What are the different patterns? Well, let's begin here with the liquidity sweep. And the liquidity sweep is when price relatively slowly breaks a swing high or swing low, and it basically traps breakout traders and then reverses sharply. So you can think about it as a more slow and effective graph. And to understand why the price moves like this, of course, we need to think about what happens above the level. So if this right here was the key level number 4, you already know that when the price break these levels, first of all, many buy orders will come in from people trying to buy the breakout. Many traders see the price pushing above the key level and buys. That leads to buying pressure. But remember here that we also have short traders that have their buy stop orders above this key level. So when the price pushes into these buy stop orders, it leads to even more buying pressure. So that is the first part of the liquidity swing, use of buying pressure, and that is what pushes the price all the way up to this point right there. But what then happens with the liquidity swing is that smart money sees all of this buying pressure, or they actually, on purpose push the price into this level to get the buying liquidity so that they can sell. And this usually leads to a sharp reversal here to the downside.
I getting through here when Blue Ward. Be a distiller. They're making beverage. I don't know what they're. Right. So this is what my mentor was stressing with me is we buy when the institutions buy and we sell when they are the best at it. As soon as we can find somebody making more money and having better accuracy than this, maybe we can start copying them. But for now, we focus on who is the best. Now, how he used to do this is he used to stand on the floor of the Chicago Mercantile Exchange, right? He used to stand on the floor of the Chicago Mercantile Exchange and he would use his eyeballs. And he knew that this guy was a trader for Goldman Sachs. He knew that this guy was a trader for UBS. And he knew that this guy was a trader for JP. And he would watch the big players. He'd be out there trading himself, but he'd watch the big players. And when one of those guys would put in a big buy order, he would put a buy order in with it. Because these big buy orders are kind of like when you throw a big rock into a pond, they make a big splash. How a big buy order upsets the supply and demand equation inside of the market is it tips it to the buy side. It tips it heavily to the demand side. And if there's more demand than supply, prices go up. So when somebody puts in that big stack of orders, again, it's kind of like throwing a big rock into a pond. It creates a big splash and that wave from the splash. And that's why my mentor used to call this riding the wave, right? Riding the wave. Same thing if he'd see somebody putting in a big sell order, he'd sell with them and he'd ride the wave back down. Now, you and I are never going to have access to a trading floor like this, but it really doesn't matter because Bookmap was created to level the playing field. A Bookmap exists to give retail traders access to the same market visibility that institutions use, right? Here are the volume dots. Here are the volume dots, and the volume dots show you every transaction that's coming through. How big is it? How small is it? Was it on the bid? Was it on the offer? So as you start to see big orders coming through, you could potentially buy as they are buying, and you can ride the wave of that order flow, right? You can see when they take over on the offer, and the offer starts pushing price down, and we can start to sell and ride it down with them as well. This is just one of the ways where Bookmap helps you stay aligned with order flow, just like my mentor used to do it on the floor of the Chicago Mercantile Exchange. When I first started trading with him, This view right here of these, what we call aggressive order flows, this was something he told me I would never have access to, right? Because we didn't have Bookmap back then. He said you'll never have access to the live exchanges going on, and most importantly, the appropriate context. The appropriate context is we can see at what price, and we can see was it on the bid, we can see was it on the offer, right? That was the appropriate context, especially that he said we would just never have access to because there wasn't platforms like this. Another way that he would stay on the right side of order flow and be aligned with institutions is he used to sneak back into these clerks' offices to try to see what was on their desk. Now, these clerks, their whole job was they worked for the institutions, and their job was they would have all the buy orders and all the sell orders from like the day before, the night before, or even the past couple of days in some cases. He would have all these buy and sell orders sitting on his desk, and his job was to fill those orders as price got up or down to them. Now, my mentor would try to sneak back in there, and so would a lot of other floor traders. They were not supposed to be going back there, but they would sneak back there and they would try to see where the biggest stack of buy orders was and try to see where the biggest stack of sell orders was. Because if they could see where these big stacks of orders were, then they knew the low for the day and they knew the high for the day before the market ever opened up. Right. Then they knew the low for the day and the high for the day before the market ever opened up. As the market opens and goes up and down, one of the things that's going to happen is these smaller stacks of orders, they're going to have bounces, but they're going to have no problem getting filled. You know, they'll create little bounces and little moves, but they're going to have no problem overall getting filled. This big stack of orders and this big stack of sell orders is a little bit different. As price comes down to this area of 71 right here, right? As price comes down to this area of 71 right here, what my mentor would have done is he would buy at 71.10. He would buy at 71.10 right in front of that big stack of orders. So he wasn't competing with them for the position. Their order was really, really big. And if that order was in first, a lot of times it would get filled first, especially with how things are now. That is definitely the case with first in, first out rules. So he'd buy at 71.10. He would know if price got down to 70.90, let's just say, 70.90, that he wouldn't want to be in that trade anymore and he would get out. What happens mechanically behind the scenes is in this case, we have 3 times as many buyers as we do sellers, right? We have 12 who want to buy and we have 4 who want to sell, which means we can pair up 4 of those sellers with 4 of those buyers. And then what happens is those get registered as volume and these end up being our unfilled orders. Our unfilled orders, it's an important concept to remember that the unfilled orders are what drive price higher. The unfilled orders are what create the floor and the ceiling in the market. These are open bids, and it is impossible, mechanically impossible, for a price to go lower as long as there is existing demand. Those have to be filled for price to go lower. That's why he would have his 2 prices in here, 71.10, and let's just say, I was going to say 60, 70.90, right? 70.90. Because if it got down to 70.90 and this whole stack was at 71, then that means all of those orders got filled and he was wrong that it was going to be the low for the day, and he would just take a small loss and he would move on with his trading. But it is these unfilled orders that control the market, and it's these unfilled bids in our auction formatted market that drive price higher. Now, you and I are never going to have access to a clerk's office like this. We're not going to be able to sneak back there. They haven't existed in like 15 years because all of that stuff started being handled electronically. But it doesn't matter because Bookmap, again, was created to level the playing field and give you and I the same market visibility that institutions use. Now, here is the Bookmap heat map and the volume dots. The heat map shows us where orders are waiting to be filled in real time. Right, here's a stack of orders, just like my mentor would see a stack of orders. And just like he came in and put a buy order, he put a buy order, and then he didn't use a stop because he was just on the floor when he did it. But we can do that same thing where we buy right in front of that stack of orders. We put a protective stop on this other side in case we're wrong. What happens though is price comes down to this area where we've identified an imbalance. We can buy when they buy, and if this area holds up and it remains with leftover demand, which we can see on the heat map, there was, then price bounces, and that's where we get to ride that wave, right? That's where we get to ride that wave. And Bookmap helps us see it all. Bookmap gives us that institutional level of visibility that as retail traders, we just really never had. We just never really had before. Now, if you don't have Bookmap yet, the best place to get a version of Bookmap, I'm assuming that most of you do. However, I know that we do have people who log into this and watch this, and they don't have a Bookmap account yet. So I want to show you where you can get that set up in case you don't. But you can go to bookmap.com and click login or even start for free, and it'll go through asking you to set up a username and password. If you already have your username and password, you can go log in here. I'm going to walk you through the steps of getting set up. Here is the Bookmap portal. This is going to be really the first place that you go when you sign in. And it's going to be helping you get your Bookmap, the appropriate version of Bookmap set up. The appropriate version meaning first off, meaning what is your operating system, right? What is your operating system? Then also select production as your version. There is beta in there, but that's just one we're doing a bunch of tests on. Always just select production, and as the updates are available, we'll roll them out to you. Go ahead and click download after that, and that will create a Bookmap installer on your download section of like your C drive, right? Or on your downloads file, I guess it's probably more an accurate description. Once you click download, the next thing you're going to do is go over to this add subscriptions page. Bookmap requires 2 subscriptions to operate. Now, some of our traders do have multiple algorithms and advanced indicators that they subscribe to, but it does only require 2. Those are things that if you decide to add on, those aren't mandatory things to run Bookmap. Those will be personal choices. Full disclosure, I don't subscribe to a single indicator, but that doesn't mean that doesn't mean anything. Everybody has different trading styles. I just wanted to be I believe in complete transparency. We have some incredible indicators that a lot of people do subscribe to. But me personally, I only use my platform and my data. A lot of that comes from the fact that I was trained by a floor trader. There was no technical indicators on the floor, so there was no technical indicators in my training. Digital is for crypto only. Then global and global plus is for futures and stocks, and you can do crypto. I am on a global plus platform, so when I'm showing you mine, just keep in mind that is the one I am on. Global plus is the only one. I mean, it has the most add-ons and the most indicators anyway. But for me, the most important thing about Global Plus is it's the only one that can connect live to a brokerage. It's the only one that can connect live to a brokerage, and trading right off of Bookmap is a huge convenience that I
Trade whisper, Moore's Law is dead. AI about the access. What did he mean by that? Advanced packaging, 3D stacking, high bandwidth memory. POWOF. AI doesn't scale on a flat plane anymore. It scales upward. So again, all these different platforms are stacking to increase efficiency. And then you'll just find something later on where even more advancements are made to make that even more efficient. But this is a way over the short term to just keep progressing at a rapid pace. You put the companies that own the Z axis own the next decade of AI compute. And so he's showing Texas and or Taiwan Semiconductor, ASE technology. I don't know that one too well. Amcor technology, Intel, Micron, DRAM. Again, I applied materials and what's this last one? I don't even know. It doesn't find it. But I personally don't care much about that. I love that Micron and DRAM are running at forward PEs between like 6 and 8 in the 8s. I love that. I love that so much. I'm just going to keep riding that train. But again, learning more about this is definitely going to be an objective of mine. It should probably could be of yours. Good morning, says M. N. Hoddle. What's up, buddy? Common Sense says, what hedges can we make against a pullback in August? I wouldn't like that. Hedges we lost everything. You might want to just look at a SATA for SPRC because it's reflected 1% one. It's not really a hedge so much. You can just sell it. It's really good at that.
You could find some nudges on your phone too. I'm not really doing right hand. I don't care much. Too much, right? And like, but who knows? Once we get to 8250, maybe I'll pass some ideas. Kobayashi letter